Hello, you're welcome to FinInvest Niger. My name is Anton Princeville, and I've been investing for the past 20 years. I am a certified securities and investment specialist. In the course of this video, I want to talk about the pros and cons of investing in index funds, the merits and the demerits of investing in a typical index funds. So let's start with the pros. Before then, what exactly is an index fund? An index fund is all about pooling capital from investor into a single unit to invest in the market. You invest this money in the market through a fund called index fund. You pooled money from investors into a single fund called index fund to invest in the market, and that strategy is called index investing. Invest in the indices that that comprises the market. Let's look at the first disadvantage. The first advantage here, the pros here. Number one here is low cost. When it comes to index investing, you discover that there's a minimal expense ratio compared to actively managed funds. Expense ratio here essentially is talking about the money, the fees the fund manager charges you. So that fee is called expense ratio. So it's relatively low compared to actively managed funds. Number two is broad diversification. There is exposure to many companies across different sectors or across different industries. When we talk about index investing, you could invest in a number of indices in the market. You have the banking index, the insurance index, uh, the consumer good index, the oil and gas index. So you have that particular broad diversification. You are adequately diversified, and by so doing, you've essentially reduced your risk as an investor. Number two is consistent market returns. So this particular index, they are designed to track the overall market performance, as the case may be. If it is a market-based index that covers the whole market, the fund there will try to mimic the performance of the overall market. If it's a sector index, the fund will try to mimic the performance of that index because the fund is essentially invested in companies in that index. Let's say a banking index, for instance. The fund there will buy virtually all the banks in the exchange, and by so doing, you end up mimicking the performance of the overall NGS banking index, as the case may be. Number four is simplicity. When it comes to index investing, it's a very simple form of investing because it is easy to understand and easy to equally invest. You simply buy the index fund and the fund manager does the investing for you. And so it's open to everybody, easy to understand, easy to apply. Number five is lower risk than stock picking. There's a relatively lower level of risk compared to you picking individual stocks. It tends to reduce the impact of individual company failure because we are invested in kind of many stocks that comprises the index. If a single stock fails, it will not impact so much negatively on the overall performance of the portfolio. Number six is transparency, because in this case the holdings mirror it tends to mirrors or mimic a publicly known index. As I told us earlier, let's take for instance the oil and gas index. The stocks we buy there are companies in the oil and gas sector. So in that case, the constituent elements, the companies in the portfolio are known to the investors. You go to the fund side, you see precisely the number of companies the index fund is holding in this portfolio. So there's transparency. Nothing is hidden about the companies the index funds are kind of invested in. Number eight is Number 7 is tax efficiency. When it comes to the aspect of tax efficiency, because of the low portfolio turnover, there's a kind of reduction in capital gain tax. When it comes to index investing, the managers don't churn their portfolio. They don't trade often. They simply buy stock maybe at the beginning of the year and hold it for as long as possible. So because they don't sell frequently, they don't get to pay capital gain tax. Usually, the longer you hold your investment, the lower the tax you pay in capital gain, and the shorter you hold your investment, the higher you pay. You pay in capital gain tax. You pay as capital gain tax. Number 8 here is no manager risk. There's no manager risk. So performance is not dependent on the skill of the fund manager. It's a function of the performance of the overall index. So whether the manager is skillful or not, as long as he buys the index, everything goes on. The overall, the eventual result is determined by the performance of the overall index and not on the skill or the experience of the fund manager. Number 9 is long-term suitability. You want to have a long-term investment. You want to hold your portfolio for a long time. Then index investing is for you. So in this case, it's ideal for those who want to buy and hold. We call them buy and hold investors. So a typical, way out is to invest in an index fund. Number 10 is accessibility. When we talk about accessibility, it's suitable for both beginners and small and even experienced investor. Anybody can buy an index fund. But as low as maybe 10,000 naira or thereabout, you are qualified to buy and own an index fund. It's accessible to every adult individual that wants to actually invest in the market. So that's all about the pros, the advantages of index investing. Now, let's talk about the cons, the disadvantages of investing in the index. Number 1 here is limited upside. There's a limit above which you will not accumulate returns. You can't accumulate returns above a certain limit because the returns here is governed by the performance of the index. All right, and so you can't outperform the market because you are the market. You are invested in the market. There's no way you can outperform the market. So you get what the market gives you. Like last year, the market generated about 50%. So as an index investor, you can't go beyond 50%. That's what the market gives you. You are a return taker. You can't manipulate your way out of whatever the market is generous enough to give you or is mean enough to take away from you. That's just the cons in this strategy. Number 2 is market risk. When we talk about market risk, sometimes there could be a kind of incident that might affect the overall market. Okay, when there's a general decline in the market. So because you are invested in the market index, you will be adversely impacted because your index, the company in the index funds part of the market, and whatever happens to the market happens to the company, and the fund would feel the impact negatively. So in this case, talk about market risk. You have there's no downside protection. There's no downside protection. In this case, there's no, you are fully exposed to a typical bear market. Whenever there's a general drop in the value of stocks in the market, you are exposed to it because you are buying the index. But if you are an individual stock picker, you know how to maneuver your way through. You know what to buy and what not to buy. But in this case, there's no downside protection at all. What's happening in the market? Essentially, you bear the brunt as an index investor. I think I've made myself clear there. Let me still recast. So in case you buy, let's say you invest in the banking index, and there is a problem in the banking sector, definitely it's going to affect you. So in that case, there's no downside protection. There's number 4 is lack of flexibility. So in this case, you cannot avoid overvalued or weak companies in the index. No, you can't avoid it. Some companies are overvalued, they're very expensive, and some companies are weak fundamentally. But as an index investor, you are bound to like buy almost all the companies in that particular sector for a sectoral index. So you buy both the strong and the weak. You can't really avoid the weak ones, and that will end up, eating into your result or your returns at the end of the day. Number 5 is concentration risk management. Concentration risk management. So in this case, discover that there's a kind of heavy, weighting in large companies or sectors. You are buying, into a particular sector. The fund tends to concentrate on the larger capitalized company in that sector, and then they will like underweight the lower capitalized one. So in that case, you discover that there's this particular concentration. When you concentrate on larger companies and neglect the smaller ones, then you are somewhat over concentrating on a particular market cap, market capitalization, as it is usually called. Number 6 is there's no active risk, there's no active risk management. There's no active risk management. All right. So in this case, you discover that you see, as an index fund investor, you can't actively manage your risk. You can't do that. It's not feasible. You simply buy the index and you go to rest. All right. There's no way you can really like try to minimize risk or manage risk in the fund. You can't do it. You only buy and allow the consistent companies to do what they feel like doing, to perform, feel like performing. You can't do anything about it. So you can't manage your risk, which is a very important, demerit of investing in an index fund. Number 7 is average returns. Average returns. Usually the returns, kind of matches the market. There's no exceptional performance. If the market gives you 30%, that's what you're going to take. Whereas in the case of an actively managed fund, the fund manager can go for something more than that. You could utilize your skills and knowledge and experience to see how you can generate a better return. But in the case of index investing, you can't do that. You simply accept whatsoever the index generates, whatsoever the returns the index gives you is what you are going to take. So it leads to relatively average level of returns. Number 8 is an index change risk. Index change risk. So in this aspect, you are kind of, you're kind of forced to buy and sell depending on the rebalancing or adjustment in the index. Let me recast. Now, the index actually is formulated by the exchange, and the exchange add in some companies and take out some companies out of the index depending on performance. If a company tends to underperform, the exchange will remove the company from the index and replace it with a better performing company, better performing stock. So in that case, you have to keep on rebalancing. When a stock is taken out of the index, you sell. When the stock comes into the index, you buy. So you keep on rebalancing your portfolio, which kind of generates risk as a result. It is called index change risk. Number 9 is overexposure to bubbles. Overexposure to bubbles. The market gyrates. The markets move in cycle. You have the boom and the bust cycle. So once there's a bust cycle, once there's what is called a bear market, you have the bull and the bear market. Once there's a bear market, you are so much exposed to the bear market. There's nothing much you can do about it. And so you are also exposed to overpriced stocks to market, during market hype. You can't do anything. And so whenever there's a bubble, you discover that you'll be so highly affected. Please like this video, share this video, and subscribe to this channel. I want to reach out to 1 million Nigerians with this particular message you are hearing about investing, so that you can have that financial independence that will help you all through life. Please subscribe. Number 10 is not goal specific. That's a very important one. Once you are investing in an index fund, you have no specific goal as per returns. All right, because one index may not suit all your investment objectives. Okay, you can't say, well, I want to make 50, 60, 70%. You can't do that because you take whatever the index gives you. All right, and you buying a single index, maybe the banking, the insurance, the consumer goods, the oil and gas, index, buying any one of them will not help you to meet your investment goals. So in that case, you have to like buy more than one index. Where a single index fund will not be able to meet up with your investment objectives. So that is a problem, and you have no specific goal in mind because you cannot just meet your target with a single index fund because you are a return taker. You can manipulate your way through to having a better returns in the market.